Hi guys, thank you so much for joining my channel. So for today we're going to discuss all about investing, and it's especially for beginners. So during this video I'm going to try to show to you guys the method of investing that I use, and it's something called the financial pyramid. And I'll show you to you guys some images right now, and we are going to discuss all the possible investing options that I currently know, and I'll try to give you guys as much detail as I can, and I'll try to also add a risk and a reward level to each of these, so it would make your life a bit easier in the future choosing which one to invest in. But also please keep in mind, when it comes to investing, it's always a risk attributed to these. So please make sure all the money you put in, you're willing to lose it at some point if worse comes to worse. Don't invest money that you're not willing to lose. So you can see on the screen a graphical representation of how I invest my money and how I think you guys should also invest. And you should only progress up one tier once the current tier is strong. So splitting these up into 5 areas: financial security, saving tools, growth investments, yield investments, and speculative investments. And I would split, if I had a portfolio in terms of investments, I would split them as a 40, 30, and 10 with a 20% in saving tools. And taking this pyramid into account, the higher up you go into the pyramid, the higher the return, but also the higher the risk. So the first thing you guys need to do is set up your foundation. And I think this is the most important step, because without this step, your whole strategy will crumble. And in my opinion, this is the most important thing you guys need to do, because you don't need to think about investing without putting in place these risk mitigation strategies. So to sum it up in one word, it's insurance. So if it's either car insurance, home insurance, life insurance, liability insurance, and even medical insurance, you have to protect for all of these items before going into investing, because this is the best strategy to have when it comes to mitigating things that are out of your control. Just to give you a simple example, you started investing, you already put your money in a specific deposit that has a 5-year expiration date with 5% interest, and God forbid you got sick and you really need urgent money, and you end up having to take a loan from the bank to actually get the proper medication you need, rather than having life insurance or medical insurance. So you really need to pay attention, guys, on this first step. So insurance is a contract between you and a company that you pay it monthly or annually, and it will protect you against a worst case scenario that you put in the contract. So for example, if you have a car insurance, that will protect you for accidents that are your fault. If you have medical insurance, then that will pay for your actual medical bills if, God forbid, you get sick. It's quite straightforward, but has a big impact downstream if you find yourself in a position of needing a lot of money to pay for a worst case scenario that you haven't protected for. Okay, so in terms of saving tools, we have 4 possible outcomes. So we have cash, banks or saving accounts, we have CDs, and we have bonds. So starting with the first one, cash, it's pretty straightforward on this one. I will classify this one as 0 for risk and 0 for return, because basically you're just putting money away into your pocket at home. But why I wanted to discuss this one is, I think it's a big mistake trying to save money this way, because you have to take into account inflation. So thinking that the government prints money year after year to support its economy, what they actually do is they devalue the value of their currency. So it's pretty much inflation. Year after year, your money has less power than it used to have. So I'll show you guys on the screen a historical graph showing how much the inflation averages within each year. But I think it's safe to say, around, taking previous years into account, around 2% each year is kind of an average inflation. So the second topic is bank or saving accounts. And they have different names, and different bank tries to give you a different name for it through its marketing scheme. But in reality, you just put money in the bank and it's called an account or a saving account. This has a risk of 1 because in theory, banks could go bankrupt, but in reality, the government always bails them out because it would have a way too big impact on the current country's economy. So, and also the government guarantees the deposits, at least to a particular degree, and the returns are quite extremely small. I think in the US, an average saving account has an interest rate of 0.05, and you can see it on screen. And again, after discussing inflation in the previous point, this small interest rate will not cover you for inflation. So it shouldn't be classified as an investment. It's, as I said, a saving tool. So the next 2 items, I'll classify them as loans. So the first one would be government bonds, with a risk of 1 because theoretically a government could go bankrupt. If it goes bankrupt, then you shouldn't really care about your currency anyway because it won't have any value. And the rate of return is quite small, like 0.5%. And the government bond is pretty much a loan that a customer could make to the government for a specific period of time, and then the government pays them a yearly interest. These bonds appear because the government doesn't really want to print money as much as possible, because then they'll increase artificially their inflation and they would again destroy kind of the value of their currency. So that's why bonds are in place. Again, minimal risk, around 0.5% interest rate per 5 years. This could go higher to 1% or 2%, but then you'd have to think about a 10 to 30 year government bond. CDs or certificates of deposits are a loan to a bank or a credit union. Similar to a government bond, this one you only loan to banks again and other financial entities. They have a risk attributed to 1 because, as previously discussed, banks theoretically could bankrupt, but the government would support them, and you could get a return around an average of 1.5%. Again, it's a lot better than the previous ones we discussed, but you are really close to the inflation rate when it comes to this one. So the next chapter, it's all about growth investments. And this is where you actually get your first taste of actually investing. And this is where the long-term compounding type of investments happen. And we could split these up into 3 parts. So we could talk about the high-grade bond investments, then funds, and then the last one we could talk about Reits, or REITs. So high-grade bonds are similar to government bonds, but with the caveat that the money you loan is not to the government, but to a blue chip company. And a blue chip company is just a term that they use. It comes from poker, but it just means it's in the top companies of that current market. And this has a risk associated with number 2, because these companies are quite well protected by the government, because they get a lot of incentives and a lot of support, because for these companies to go bankrupt, they will have a big economic downfall for the actual government. And the return is between 3 and 5%. And the reason why they request a bond is not because they need money to not go bankrupt. Is sometimes they need a lot of cash flow to support a new product that they are launching. So if that product is going to give them a return around 30 to 50%, it makes sense to get a 5% loan from I guess, the taxpayers who are willing to do this rather than the banks, because they might have maxed out their loans in terms of banks. Now, the second one is funds, and I named this funds because you can find them under different names. So you have investment funds, mutual funds, you could have index funds. They come by with so many names, but the reality is a fund is just a financial tool where a lot of people put their money together to reduce their risk, and it's normally run by a different fund manager. And these have a risk associated with them between 3 and 5, and their return, I think I will classify it between 5 and 20%. And why is this variable risk between 3 and 5? Well, it depends how diverse they are. So I will classify a free risk to a fund that is globally. So that means it invests in all the markets and invests also in all the sectors. So it's going to have a lower return, but also a lower risk, because globally it always starts hedging out. If a market goes bad in, let's say, US, then the European market might do well. If, let's say, automotive sector doesn't do well in a specific period, maybe the medical sector would do. And then if they invest just in a few markets and a few sectors, then I will classify them as a 4. And a 5 is when they invest in only one market or in emerging markets. Those are the riskier markets, but again, they bring out the highest return. And the last one, Reits, or real estate investment trusts, they have a risk associated between 4 and 6 and a return between 10 and 30. And it's pretty much the same as funds, but these guys don't invest in stocks and shares. They just invest in real estate. And I put the risk a bit higher because while in a specific fund, you could get out quite quickly because they're liquid. So a share, as you know, you could sell it instantly online, but with brick and mortar, if you invest wrongly in a, let's say, real estate property, then it's kind of hard to get your money back quickly. So that's why these come with a higher risk. And again, they have the same rule as funds. So the more diverse and general and global they are, they come with the lower risk and lower return, but the more targeted to a specific market and a specific area return, but also the higher the risk. Okay, guys, so the next chapter is called yield investing. And this is where you need to put all the effort in research and understanding the market, because this can make a big difference between a great return and a big loss. So I will split this up in 3 areas. I think most people know these by now. So it's stocks, real estate, and commodities. Stocks are pretty much a way for you to invest in a company. So basically, when you buy a stock, you literally become an owner of that company, and you kind of owe a small percentage of that company based on how many stocks you actually buy. And I always split these in 3 areas, so large, medium, and small cap stocks. So a large stock is a stock that has a market capitalization of over 10 billion, medium is between 2 and 10 billion, and small cap stock is between $300 million and 2 billion. And I would give this type of investment a rating between 7 and 9. 7, of course, is for the large cap, and 9 is for the small caps. And of course, the return is always based on the investment. So if you go for a large cap stock, it's a lot safer, but the return could be a lot smaller. And if you go for a small cap, again, the risk is higher, but the return could be higher. And before I forget, I would add the return for these type of stocks. I would say 10%, but this is a really, really big average based on recent years on the S&P 500. So with stocks, it's quite hard to give a real return. You can make a lot of money, or you could lose again a lot of money in these type of investments. The next type of investment is real estate, and I'll give a risk rating for this one for 10. And this is because compared to stocks, this one is quite hard to get out of. So when you buy a stock, you could put some risk mitigating tools as a stop loss, or you could go out of a stock anytime because you could just sell it. But for real estate, it's a lot harder to get out of a bad investment because you already bought the property. It's quite hard to sell it. And even if you sell it, there are a lot of fees linked to the purchasing of selling of a property. So it's a lot harder to do it. And you need a lot more capital also, because a stock is divided into many small particles. So you can even invest $10 in a stock, where in property you need to come up with a lot of cash up front. So that's why I attribute the risk to it. So also the return, I would say it's an average 8%, being on the conservative side. And again, this is an area where you need to do a lot of investigating and figuring out the type of approach you want to have. Either you go with a safe bet, maybe in a center of a town, but the return is not going to be as big, because while the demand is always going to be there, the cost is really high. Or you try to invest in a bad neighborhood, or maybe outside of a town, and hope that area bounces back, and you play the long-term type of game. So the last one is commodities. And when I say commodities, I more kind of think about the general ones, or the most well-known ones. So in terms of gold, silver, copper, platinum, oil. And again, this one tends to be a lot riskier than the previous ones, because you need to really know a lot of industries that kind of use these commodities. So you have to understand the demand, the production, and even the reserves, and a few rules of general markets. So that's why I would put these as risk 12, with probably a 10% return per year. But you have to be quite knowledgeable in the type of commodity you want to invest. So to give an example, if, for example, a market goes bad in terms of its currency, then people tend to go back to gold. So if you see a currency going down in the market quite fast, you will see a lot of people starting to buy gold and sell their currency, just to kind of protect for inflation, because gold seems to be historically quite a good investment in terms of protecting yourself in terms of inflation. But in terms, these come with a specific set of risks. So again, talking about gold, you can't really divide gold as much as you would divide a stock, right? So physically you can't really cut gold to like really small levels. Also, you need to think about storing it, transporting it, having it in a secure location, and all of these type of items really you need to factor them in when making an investment in gold. And also think about this: if you buy, let's say, $1 million in gold, it's not easy to move that type of investment and try to sell it, because you could go in the stock market and easily find a broker and sell a stock. Or you could find even faster somebody who is willing to buy a real estate if you bought it in the right place and the right time and has the right price. But having a really big investment in gold, there are not that many buyers around that can invest that much money in such a high quantity. So keep that in mind when investing in commodities. So guys, now we're at the top of a pyramid. So this is pretty much where research meets experience and passion. And this is where the risk is through the roof. So that's why I'll put it as 12 in terms of risk. And returns, I can't really say and give you guys an average return, because pretty much here you could 10x your money in a day, or you could lose everything in probably 2 seconds, because here is the most riskiest and the most lucrative area in investing. I will split this into 4 areas. So the first one is Forex and cryptocurrency. The second one is stock tools. The third one is micro and penny stocks. And the last one is pretty much speculative commodities. So the first one is Forex and cryptocurrency. So Forex or Forex exchange is pretty much the ratio between 2 pair of currencies. So the most common ones are, for example, USD and Euro, or USD or GBP, or GBP versus Euro. And pretty much you're trying to study the difference between 2 currencies at the moment in time. And this could greatly fluctuate depending on the country of that currency's power. So if it's USD versus GBP, for example, it's always, you have to figure out if the economy of the US is going to become stronger versus the economy of the UK. And that's why this one is quite hard to grasp, because it could be quite schizophrenic when you try to do maybe day trading in Forex, and it's quite hard to predict. And the second one is cryptocurrency, and I think this one has been discussed online so many times with, I guess, the most common cryptocurrencies available are Bitcoin, Ethereum, and maybe Dogecoin, if you heard of this. And I would classify these as, again, high risk, because if you look in the past, the, I guess, swings up and down are quite violent, and you could easily get yourself caught off guard in a hype for a specific cryptocurrency where you could lose a lot of money. And you saw, I guess, Bitcoin, for example, if you check previously, yes, it has made a lot of I guess, progression when it comes to its value. But if you check per year how much it fluctuated, you could get easily caught off guard with it. So in terms of stock tools, we have quite a few available, but I'm only going to talk about the most common ones. So the first one is shorting, and this is pretty much where you try to predict that a stock is going to lose in value, and you are going to bet against it. And if the stock goes down in value, pretty much that's when you profit. And there's an underlying risk here, because if you own a stock, for example, and if it goes to zero, then you pretty much lost the value of that stock. But if you short a stock, there's no limit to how high that stock could go. So your risk versus reward changes drastically. So this is where you need to really pay attention. The next 2 stock tools, I'll bunch them together. It's Spreadbetting and CFD. So CFD stands for Contract of Difference. And this is pretty much where you place a bet on where a stock is going to go, either up or down, with another party. And this is a tool where you try to predict the movement of a share in which you don't need to invest in a share. So you could make money on the volatility of a stock. Again, this is sometimes coupled with trying to use a multiplier. So for example, if a stock goes 5% up in a day, but you have in this contract a multiplier, let's say, of 10x, that means you could, for 5% movement, you could get 50% movement, or if you predict it the other way, you could get a 50% negative. So it's quite easy when you use quite high 10x, quite high x's in this situation, to lose your money or to double your money quite fast. And the last 2 items in this area for stock tools, I'll classify them as options and futures contracts. And this is pretty much a contract between a buyer and a seller, and they will stipulate that they will buy an amount of stocks at a specific time and at a specific value. So this is pretty much used by, I guess, investors to limit their exposure. So let's say you want to invest in the future in a specific stock, or you have money invested in a stock and you're afraid the price will go up and down depending on your situation, if you're buying into a stock or shorting it, this is a great way to, I guess, limit your exposure, because you could set up a contract saying, okay, I'm going to pay you this amount of money, but in terms when I'll buy or sell this stock at this specific price. So if the market goes against you, you have that contract you can use to put in effect, so you won't lose that much money. So for example, if you have a specific stock at $100 and it's quite volatile, and in the future they might announce their earnings and you're quite pessimistic about their earnings, you could put in place this type of contract and you'll limit your losses. And it's quite easy and to use, but it has to be used in conjunction with other tools to be effective. Micro and penny stocks are pretty much stocks that have a market cap, I think, under 300 million. These are for micro stocks. And as you guys know, the smaller the stock, the bigger the volatility. So you can make a lot of money if market goes your way, but most of these stocks end up losing their value quite quickly. So again, you have to do a lot of research and know quite well the field to kind of justify going into a penny stock. But keeping that in mind, also Amazon and Apple were one-time penny stocks, and now they are in the large cap stocks. So you can imagine if you invested in these companies back then, how much money would you have made? So again, you kind of need to have a bit of a crystal ball here to make profit, but it's a great way to invest quite a small sum of your money in this, and who knows, maybe your experience, your passion, and a bit of luck, you can make a lot of money in this area. And the last one here is, I'll classify these as speculative commodities. And this is quite an open-end topic. You could invest pretty much in anything that you think it's a commodity and it would increase in value. So you could buy a watch, and if it increases in value, probably 2, 3, 5 years down the line, and you sell it and you make a profit, I will classify that as a speculative commodity. If you buy a really nice vintage car, keep it for 10 years and sell it, and if you can make a profit. So this is where everything is possible. It all depends if you really understand quite well the market. So you could invest in watches, cars, memorabilia, clothes, whatever. If there's a market for it and you think it's going to increase in price, it should be classified as a speculative commodity. Thank you so much, guys, for your time and for listening, and I hope you found it quite entertaining and useful.